So let's wait 2 minutes maybe. Okay, so number is increasing, so maybe we can start now. You confirm you can hear me? It's fine? So let's start where we stopped yesterday. So here we are. You remember, this is the last slide I have presented yesterday. So we discussed about insurance and more precisely on insurance pricing, which is one of the main difficulty insurers have to deal with, because it's difficult to price a risk when you don't know exactly how much it will cost if you decide to take the risk. And not only you don't know exactly how much it will cost, but you don't know exactly when you will have to pay. Okay, so it's a kind of tricky situation for insurers to manage their liabilities. Okay, so as I told you, insurance have their own limit. They have their own limit because they have a certain amount of equity. They have regulations to comply with in terms of capital adequacy. So for a certain amount of equity, you are kind of allowed to accept a certain quantity, let's put it this way, a certain quantity of risk. And above, if you wish to please your customers, if you wish to take more risk, well, one solution might be to transfer part of this to the reinsurance system. And the reinsurance system, and that's a difference with the direct insurance, which is mostly a national activity. There are national regulations usually. Okay, if you want to operate within a country, you need a license to operate. Okay, so it's very national when you look at the insurance activity in itself, but reinsurance is more like a global type of market, which is normal because the reinsurance market is a kind of solution for insurers to insure themselves. Okay, so as we said, reinsurance is the third layer. Following retention insurance, you have reinsurance, but reinsurers also, as we said, have their limit also, because they also need equity, and their limit is indeed based on the level of equity they have. So even though there are many reinsurers who can share risk, there are still limits that exist. And on the top of the pyramid, well, you need to find other solutions, and particularly the solution is a state, which can be seen as an insurer of last resort for very severe catastrophic risk, typically a natural catastrophe, very severe ones, large terrorist attack or case of war, and so on. Okay, well, and as we said, reinsurance is all the more important today that we have an evolution which we have described in the introduction, such an evolution with a narrow base because there was an improvement in terms of safety, prevention, and so on, but you have more severe peak risk, which is the challenge today for the reinsurance market. That's why there are new solutions to be found, okay? Need for new solutions, and this is what we're going to see now. I'm going to start with the traditional reinsurance system as it used to be, okay, as it is still today. But after that, we will focus on the new type of solution which are brought in and developed. And you'll see that insurers can be very creative. So what is developed to cope with this top of the pyramid, which corresponds to this growing severe catastrophe in terms of frequency and severity due to, as I mentioned here, natural catastrophes, cyber risk, terrorism, which are the main issues to be handled today. Okay, so let's look at traditional reinsurance first, as I said, and let's focus on its organization, how it works. So to start with, you have a policyholder. Okay, the policyholder is looking for, he's a policyholder because he has transferred the risk to what we call direct insurers. Okay, direct insurers, those traditional insurers, which you know, okay, we call them direct reinsurers as opposed to reinsurance. Okay, so as you can see on this slide, you can buy for a particular risk insurance from a group of direct insurers. That would be the case particularly for very large risk. If you have a large risk, well, maybe one insurer alone cannot take it. Let's take the example of an airline company such as Vietnam Airlines, for instance. Okay, it's a big risk because you know the cost of an incident in this activity might be very high. So insurers may not like to take the whole of it. So one way to deal with that type of situation is to share the risk between insurers. So this is what we call co-insurance. It is different from reinsurance. It is not that common today, but it used to be very common. Okay, the reason for that is that it's a way to keep the market at the national level. If you have a closed market, if you are protectionist, let's say, well, rather than going abroad with reinsurance, well, you can have kind of agreement between local insurers, and they would take the risk all together, okay, within a co-insurance system. In this case, each insurer is responsible for the share of the risk he has accepted, okay? So each insurer is independent and take his share of the risk. If one insurer fails for any reason and is not able to meet its commitments and to pay compensation, the others are not concerned with that. Okay. Well, so I just described it. I just mentioned it because it exists. Okay, but this is not the most common practice today. Okay, so now if you have a minor risk such as you want to insure your house or your car and so on, usually you deal with one insurer, one direct insurer only. So reinsurance is at the second step. Okay, if you take the first direct insurer on this graph, DI1, well, if there is typically, let's assume that DI1 would be the insurer of Vietnam Airlines, which is a large risk, and this risk maybe might be considered as too big to be kept alone in the balance sheet, and therefore the direct insurer, let's say Bao Viet, for instance, might decide to cede part of the risk to reinsurers. And I say to reinsurers with an S, because usually, as we'll see later on, it's not only one reinsurer who is taking part of the burden, but you have a group of reinsurers under certain types of agreement, which we are going to describe, which are there to meet the demand of the direct insurer. So this first step is what we call cessions, and the direct insurer is a ceding company. Well, what about reinsurers? Reinsurers, well, they might have accepted to reinsure because they feel it's a good deal. They feel that the share of the premium they will receive is large enough to cover the risk they take. But they might decide later on or immediately to retrocede the risk or part of the risk they have taken in the first place. So, you have a kind of cascade of reinsurance, okay? You have at the first level what they call sessions, then the second level with retrocession, and then you could have retrocession and so on, okay? Just to show you here that typically for very large risk, and let's keep the example of the insurance for the fleet of an airline company, a large airline company, which is a big risk. Usually, the risk is shared between a large number of players through the sessions and retrocessions. Okay, so here, this slide, I think, describes rather well the systems through which one big risk, will be disseminated within a whole system with a lot of players involved. Okay, so that's for the description of the system. Okay, so now let's look at try to identify why are companies, direct insurers, willing to reinsure. I told you that first of all have constraints, which is their capacity which depend on their level of capital, their level of equity. Okay, but there are other reasons for reinsurance. So let's look at how reinsurance will affect the insurer's balance sheet. So you start with an insurance demand coming from companies, from individuals, and so on. And the company has a sales policy. The sales policy corresponds to the strategy of the company, the commercial strategy, focusing on certain type of customers or a certain region or a certain type of risk and so on. And this strategy will lead to a portfolio of risk, which we call the accepted risk. That is the risk that the direct insurer is ready to accept in the first place. Okay, and usually, if you pretend to have a dominant role in a particular country, for instance, well, you are kind of obliged strategically to say, well, we are ready to cover anything you want. So you want to please your customers, you want to provide a full set of services. So the accepted risks are usually very broad. Okay, then the question is, are you happy with what you have, the portfolio of risk you have following your acceptance strategy? Okay, you may have a bad, let's say, a portfolio of risk which is not well balanced. So you may wish to rebalance it. Maybe you have too much of a certain line of insurance, which would have too big a weight in your portfolio. Maybe you are missing some type of risk where you are weak, So you see, you may like to rebalance your portfolio of accepted risk. And that's where reinsurance will play a role. Once you have accepted risk, well, you will have a retention policy. What do you keep with you? This is what we call retention. Okay. And what do you cede? You cede to the reinsurance market some risk which either you don't like to have in your portfolio or to rebalance your portfolio because maybe, for instance, you have too much of this type of risk. For instance, if you have a large portfolio of motor insurance so that it would represent 50% of your underwriting portfolio, you might say, well, that's too much. The weight of this line of business is too big and my underwriting portfolio is not well diversified. So 50% is too much. So I will cede part of this block of motor policies to transfer it to the reinsurance markets through a cession. Okay, well, now you can look at your portfolio following your retention policy. Once you have ceded some of them, you say, well, I have retained. What about my portfolio of risk? Well, I just realized that there are some lines which are very weak. Why? Because maybe my commercial network did not allow me to take so many of certain type of risk. Maybe I don't have a good position when it comes to selling insurance to companies, to certain types of industries. So here I'm weak. So what can you do? You can be a reinsurer yourself, okay? And you can, through the reinsurance market, accept as a risk which are kind of missing or with a low weight in your underwriting portfolio. So when you look at this, you see that reinsurance is a way to comply with the size, the quantity of risk which you can keep in your balance sheet. Okay, this is a capacity issue, but it's also a way to restructure your underwriting portfolio by ceding risk which you don't want to have in your portfolio, and through the reinsurance market to accept other risk which you couldn't get through the direct insurance channel. Okay, so if you summarize, what are the reinsurance functions? Capacity first, which is what I mentioned first. You have a limit in your capacity, which is in relation with the amount of equity you have in your balance sheet. That's the first point, okay? Your strategy might lead you to accept more risk than what you can really keep for you, considering your level of equity. That's the first point. The second point is diversification. I told you in the introduction that you should look at an insurance company like a twin portfolio, with a portfolio of policies, a portfolio of liabilities, and on the other side, a portfolio of assets, hence the relevancy of this ALM, asset liability management approach, okay? So diversification is a key element on both sides, okay? So diversification can be developed, can be enhanced through the reinsurance market to get rid of or to reduce the weight of the risk which are too much represented in your portfolios through sessions, and you can complete certain lines of business which are weak in your underwriting portfolio through the reinsurance market, okay? That's the second point. The third point is income smoothing, okay? Yeah, because as we'll see, it's a problem, and that's particularly true when it comes to the insurance of low frequency, high severity risk. This is one point which I did comment yesterday when I was mentioning all the difficulties that practically insurers have to deal with. When you have to deal with low frequency risk but potentially catastrophic, well, that's an issue. So as we'll see, there are solutions through the reinsurance market to, let's say, reduce the difficulty linked to this type of risk, and avoiding particularly to have to face to huge losses and huge compensation to pay. So through this, you'll see that you contribute to smooth the income, to reduce the volatility of the performance of the company. Okay, solvency also, we'll see it's a complement to income smoothing. It means also that you will find through the reinsurance system solutions to limit your commitment to a certain amount of payments for certain very severe risk. Okay, and indeed you will increase your solvency by reducing drastically the probability of having to pay huge amount of money that would go beyond your capacity to pay. Okay, and we need also to mention arbitrage. You know what arbitrage is? Arbitrage is when you buy something cheap to sell it at a higher price. Okay, so the reinsurance market can be seen as a market for risk. Okay, so for instance, you may cede a risk just because the reinsurance market is in good conditions for this type of risk, and you can transfer it for a cheap price. So in direct insurance, you can charge a premium, and you can realize that you can transfer the risk in good condition to the reinsurance market so that you keep a margin. On the other way around, you may decide to take some risk on the reinsurance market because the conditions are good. You can get a good premium for it, okay? Better than what you would get would you find the risk on the direct market. So you see, you can make arbitrage there, and this is also a source of profit to improve the performance of the company. Okay, so you see, reinsurance, there is a major function. The first one is capacity. I would say diversification is also important. Income smoothing also, okay? But, there are many functions, okay? Well, so having said that, I guess you have a better understanding of how it works and the role of reinsurance. So now let's look at the importance of reinsurance. This is global reinsurance. Cession rate is growing. Okay, this is again a document from Swiss Re, which is I mentioned this large company, which is a major source of data and information and studies in the field of insurance. So if you are really interested in this field, I recommend you focus on that. You will find a lot of things there. Okay, you again have the web link. So you see, you have insurance premiums. These are in billion US dollars. This is Association of Reinsurance Professionals in France. That's for the French company, if I remember well. Okay, you see for the last 10 years, insurance premium, you have the reinsurance premiums, and you have the cession rate, which represents just the ratio of reinsurance over direct insurance premiums. Okay, so it's you have a slow growing trend, moving from, let's say, 4.6 up to 509, with a peak to 527. But you see, as you can see right now, we are around 5%. You might tell me, well, it's not that big. 5% is not that big, but it's essential. It's not because it's only 5% that it's not important. Okay, it is essential for the reason which I have mentioned before, particularly because it allows companies to smooth their their income, to improve their solvency, and also to keep in line with their capacity rules. Okay. Well, so now I've mentioned reinsurance with companies ceding risk to others. Well, what are the type of agreements which takes place between direct insurers and reinsurers? Okay. How does it is organized, this transfer of risk? So there are two types of agreements, by the way. You have reinsurance treaties. Okay. A reinsurance treaty is for, I just read the text, for a predetermined class of policies. For instance, let's assume that you have a large portfolio of motor insurance, okay, which is a very traditional, classic type of insurance, which is usually well known statistically. So you don't have much risk there because your estimate of the potential losses and so on are rather reliable. But you may consider that your portfolio of motor insurance, this line of business, has a too big weight in your underwriting portfolio. So you decide to say, well, now I define a group of policies, which would be motor insurance, with a policy with certain types of specification, which are well defined. And for this class of policies, and for a period of time, you decide that systematically, automatically, you transfer part of your risk to the reinsurer. Okay? Part of the risk, which means that, for instance, if you decide to transfer 30% of this risk to the reinsurer, it means that for each policy, each new policy issued in this class of policies, you will transfer 30% of the pure premium to the reinsurer, and the reinsurer indeed will participate for 30% of the cost of claims in this line of business. Okay, so there is no discussion. Each time there is a new policy, well, you have automatically a transfer of part of the risk to the reinsurer, and this is done as part of what we call reinsurance treaties. Now, the other type of agreement is what we call facultative reinsurance. Then it applies to a particular policy covering a specific risk. Typically, well, the airline company, Vietnam Airlines, you have a specific risk for its fleet in case of accident with an aircraft, okay? Or it could be a bundle of risk. You can have one agreement, for one specific risk that would include the aircraft and also all type of risk linked to this, okay? So you have a clear scope for one, and you have one policy, and the reinsurance is just for this risk, okay? this particular policy, which you have defined with the reinsurer, and you have defined, and we'll see later on how, the conditions under which the reinsurer will have to compensate for and for which amount. Okay, so you have in one case a reinsurance treaty, it covers a group of policies, and there is a kind of systematic transfer. Facultative reinsurance, it concerns a particular policy. Usually it concerns large risk, which are too large for the direct insurer to keep all of the risk alone. Okay, whereas for the reinsurance treaty, it's more to transfer part of your line of business, because this line of business would have too high a weight in your portfolio. Well, so now another distinction to be made when you look at the different types of agreements. You have proportional reinsurance, which is typically the case when you have reinsurance treaties. Premium and losses are calculated on a pro rata basis. It's the example I took before. If you transfer 30% of your motor insurance line, it means that for each policy, you will transfer 30% of the premium to the reinsurer, and the reinsurer will take care of 30% of the losses for this group of policies. Okay. Now you have non-proportional reinsurance. That would be more the case of Vietnam Airlines. Okay. Losses in excess of the ceding company's retention. The ceding company will usually say, well, I would pay for losses up to a certain amount. Okay. And beyond this amount, well, losses would have to be covered by the reinsurers. Okay. We call that non-proportional. In other words, in non-proportional, you share. You say, well, as a direct insurer, I would agree to pay for losses, all of it, 100% of it, as long as it is below a certain threshold. If the losses are higher than the threshold, then the excess beyond the threshold will be covered by the reinsurance market. Okay, so losses in excess of the ceding company's retention limits are paid by the reinsurer up to a maximum limit, and this for good reason, which we will understand later on. Okay, so proportional now, you have different types of proportional, quota share or surplus, and I will explain what it is. And when it comes to non-proportional, you have excess loss, stop loss, or max claim, and I will explain all these. You know, I just give you the main type of reinsurance agreement, but you should be aware that particularly for non-proportional, each case is kind of unique, and you may have very specific stipulation. Here you have the most common categories, okay? But within these categories, you could have also a lot of distinctions. I'm not going through all the details here, okay? Excess loss, you also have this, just to add a bit of complexity. It can be per loss. For instance, if you have let's take the example of Vietnam Airlines, it could be for a particular accident, you can have a certain type of loss for which there is a coverage. It can be per occurrence. Per occurrence, it might be, for instance, if there is one accident, okay, and then it would cover all the consequences of this accident, or per year, that is, it can be based on the total amount of losses for a year. Well, here, I'm not going to read that, but you have all types of definitions. I gave it for your information, and it comes from the International Risk Management Institute, where you can find all these details if you like. So I'm not reading this. I gave it to you for your information. Let's look now at the different types from a statistical point of view, at the different types of reinsurance agreement. So here we look at the impact of proportional reinsurance on the risk exposure of the insurer. You know, let's assume R, the reinsurance rate in terms of percent, Y, X is the size of the loss, okay, and we call Y the residual risk for the ceding company. That is the risk that remains for the ceding company after reinsurance. So obviously, if it is a proportional reinsurance, Y equal 1 minus Rx. In other words, if you have a reinsurance rate of 30%, Y will be 70% of X. You know, if you transfer 30%, then you keep 70% of your risk. So how would it affect the risk exposure? If you look at the expected loss, the expected loss will be, if you have 30%, for instance, will be 70%. The remaining, the residual expected loss will be 70% of the initial expected loss. Okay. When it comes to the standard deviation, okay, well, of losses, it will be also 70% of the initial standard deviation. So if you look at the probability curve, let's assume that Fx is the probability of losses, okay? Probability of losses, what will be the impact of proportional reinsurance? You see that since you move from X to 1 minus Rx, you will have a shift to the left, okay, showing that, first of all, the volatility of the losses will be lower. You see the standard deviation is reduced, okay? And also, and that's an important point, you know, the maximum probable loss, MPL, which is an estimate which insurers need to do. What is, in the worst case scenario, how much would it cost? And usually they impose a limit in the policy, okay? So the MPL can be a limit which is fixed by the insurance company, because we'll understand why later on, but because, you know, they are ready to pay a lot of money, but they need to know what is the maximum they would have to pay in any case, okay? So this maximum probable loss, sometimes we say maximum possible loss, okay, after reinsurance will move to the left with MPL time 1 minus R. And you see, so the impact in terms of income smoothing is clear also here. You reduce the volatility, okay, and at the same time, you also reduce the maximum amount you might have to pay, okay? So this is the impact of the proportional reinsurance. No, now proportional reinsurance, I told you, you have quota share or surplus. So here, these are columns which represent a situation where you would have a portfolio of 4 risk only. Well, it's not realistic, you know, usually it's not 4, it's much more than that. And let's assume that you are insuring buildings, okay? And if you insure buildings, you have a typical policy for that. That can be described and that can be used for the definition of the reinsurance treaty. But it doesn't mean that all the buildings are exactly the same in terms of value. Even though they are covered by the same type of policy, the capital at risk, which depends on, for instance, the size of the building, may not be the same. Here, for instance, we would have 4 buildings, one bigger than the others. Let's assume a very high tower, and its value would be 180. And you have 2 smaller ones, 75 and 80, and in the middle you have another one with a value of 100. Okay. So these are the risks included in your portfolio and which will be part of the treaty. Okay. So if you assume a fixed rate of 50%, okay, if you have a quota share, this is proportional reinsurance, as I have explained it so far. That is, the retention will be in here blue. It's 50% of the value, which means, for instance, for the biggest building, the maximum you would have to pay in case of the full destruction of the building would be 90. That is half of the total value. It would be only 40 for the other ones, 37.5, and 50 for the others. You retain 50%. Okay? Well, if you look at this, you may not be happy with it because you say, well, if I take the small building, I could be more, let's say, I could keep more of it. I am ceding part of the risk that I could keep because, you know, altogether it's a small building, it would not cost too much, you know. And when you look at the last one, 180, it means your exposure is 90. And you say, well, 90, that's a bit too big. I would love to have it lower. So you see, you may not be happy with this quota share system because it leads to, let's say, a level of insurance that you would like to increase, a level of retention you would like to increase for the small risk, and a level of retention you might like to decrease for the biggest risk. So what is the solution? The solution is the proportional reinsurance surplus. What do you do there? You say, well, I decide of a fixed amount, which will be what we call the surplus. You say, well, for any of these risks, my retention is 50. Okay. Once you have defined this level of retention, which is 50, which is not a percentage now, but a fixed amount. But you know, having a fixed amount, if you consider each individual risk, then you can define a proportion that apply to these specific risks in the reinsurance treaty. Okay, so in the reinsurance treaty, it is still kind of proportional, but the proportion is not the same depending on the size of the risk. Okay, so would all the risks be exactly similar with the same capital at risk? The two solutions would be similar, but the surplus can be used and is often used when you have a treaty including similar policies but with different value at risk. Okay, so you see, for instance, here that you retain 50 systematically. It would correspond to a proportion of 50% for the first one, but when you move to the biggest risk, you know, it would represent only 27.7%. So your retention rate is lower for the big risk. Okay, so that is what we call proportional reinsurance with surplus. Okay, which apply usually when you have similar policies but with different level of capital at risk. Well, so now let's move to non-proportional reinsurance. So I start again for my explanation with the distribution of losses. This is a probability distribution of losses for the risk you are insuring. Let's say it could be, let's keep in mind, for the sake of practicality, the idea of Vietnam Airlines. Okay, and you are Bao Viet. I don't know, by the way, whether Bao Viet is the insurer of Vietnam Airlines. It's very likely, but to be frank, I don't know, but let's assume it, okay? Well, you know, you may not be comfortable with that as a direct insurer because if you were on the extreme right, it may be a very huge loss. You can have a catastrophic event, you know, with an aircraft falling down on a big city in the US, that would cost you a huge amount of money, okay? Well, so maybe Bao Viet wouldn't be comfortable with that. So what can be done? Well, first of all, Bao Viet will determine what we sometimes call the attachment point, or let's call it, it's easier to understand, the retention limit. In other words, Bao Viet will say, you know, for all these parts up to L0, well, I would pay for the losses. And the rest above, beyond L0, well, I want this to be taken care of by reinsurers. So you keep the easy bits of the curve, where you can have a reliable estimate and so on, and you transfer the kind of unknown. Because one problem also is that when you look at the extreme events, the probability is very tricky to assess. So, you know, you don't have a good knowledge, usually, of the probabilities of extreme losses. So there is also not only, it corresponds to amount of losses which might be huge, but also they are not known with a strong reliability in terms of probability of occurrence. Okay, so it's a tricky part of the curve. How can you expect that a stupid company would say, okay, you take the good share of the cake and I will deal with the messy part? Nobody would accept this. So what is the solution? Well, maybe a reinsurer would say, not maybe, because that is what's happening, by the way, beyond L0, I would pay, but I will impose my own limit. Okay. The first reinsurer will say, okay, I pay. but you know, I don't want to take too much risk because this is a very unknown area. So if it's above L0, I will take care of this part, but I will not go further than L1, which means that, you see, the first reinsurer is going to take a tranche of the risk. It will pay for everything that is included between L0 and L1. Okay. In other words, the maximum amount you would have to pay would be L1 minus L0. If, for instance, L0 is, let's say, 100 million, and L1 is 110 million, that is, that the first reinsurer would not have to pay more than 10 million. Okay, so the problem is that you still have a bit to transfer. So you need to find a second one and a third one, and so on. In other words, you split the risk in tranches. And for each tranche, you will have a reinsurer coming in and say, okay, I accept to pay if it's, for instance, the second reinsurer would pay, okay, if the losses exceed L1, I will start paying, but I will stop paying if it goes beyond L2. So again, the maximum loss for the second reinsurer will be L2 minus L1. Okay, so you know, you have a group of reinsurers that are not taking too much risk because they intervene only on a tranche of this, okay, up to L5. And now I come back to the comment I made before when I told you that reinsurers and insurers like to impose a maximum loss. The maximum loss might be huge. It's, you see, when you see that, it's no problem because we could go even further right, okay, with as a tranche. But we need to know where is the maximum to know where we stop this sharing process. Okay, so L5 would be there because it will be stipulated in the policy that in any case the system would not cover losses beyond L5. Okay, which would be a kind of maximum imposed by the reinsurers. Okay, so if you look at the definition of non-proportional reinsurance, losses in excess of the ceding company's retention, so the right part of the curve. So these losses are paid by the reinsurer up to a maximum limit. You see, each reinsurer is putting a limit. The reinsurance is frequently placed in layers. Contracts may be continuous or for a specific term. Okay, so that's the way it can be shared. And as I said, typically a maximum loss is imposed. Now, the problem is there, and it's a very tricky issue. Normally, as asked the question in class, if you, the direct insurer has negotiated with, let's say, let's assume you had a negotiation between Bao Viet and Vietnam Airlines to determine a premium, okay, for the insurance provided. Okay, let's assume that premium has a certain amount, and let's assume even that this amount is reasonable and agreed upon by all the reinsurers, which consider that Bao Viet did a good job in terms of pricing. Okay. Okay. So there is no discussion on the price, whether it's underpriced or not. Okay. So there is a kind of normal market premium. Now the question is, how will this premium be shared between all the players? Okay. If you are a specialist in statistics, okay, if you are familiar with this type of analysis, then you would say theoretically there is no difficulty to share. Why? Because you see that with this curve, we know what is the share of the risk, the share of the volatility taken by each. If you know perfectly the probability distribution, we could find a kind of formula to allocate the premium with a share for each participant that would correspond to the risk exposure taken by this one. Okay? The problem is that usually we don't have a perfect or reliable knowledge of this probability curve. So it's more a kind of negotiation, you know, and that's why on the reinsurance market, premiums are fixed. Depends a lot on the market. There are periods where reinsurers are making a lot of money and therefore they are aggressive and they are ready to reduce their the price they are ready to accept. There are some moments when the reinsurers have a lot of losses have occurred and the reinsurers are more demanding. So you have fluctuation of the prices on the market, which also reflects the fact that it is very difficult to fix a price for that. Okay, that's where the difficulty is, since we don't know perfectly the probability distribution. And that's the case for most of the catastrophic risk. Typically, that's the case for what I mentioned yesterday, this low frequency, high severity risk. For this, they are not well known in probability terms. Okay, sometimes we have no historical data, we have not enough experience, and it's very difficult. You have some, I will show you the example later on. You have some institutions which are specialized in trying to assess this risk, the probability of occurrence and all that. But this remains very not quite reliable, to be frank. How can you predict seriously the probability of an earthquake occurring in Japan for the 6 months to come? There are numbers, indeed, but to which extent can we count on these numbers to price? That's another story. So there is a kind of, I wouldn't say bets made by insurance, but to a certain extent, yes. They bet on the fact that, well, they take this premium and they think it's a good premium, but, well, nobody knows really. Okay, so that's for the non-proportional reinsurance. And let's look at another example, which would be a bit different. Okay, but it's another approach. But again, I just give you a few examples. But as I said, you have many sub types of reinsurance treaties. And I'm not going too much into the detail. I just show you another case, which is non-proportional reinsurance with the highest claims. For example, the reinsurer might accept to pay for the 2 highest claims. Okay? That is, you have a portfolio of risk. It could be like the buildings we had before. Okay? But you have a series of accidents. Okay, within the portfolio, not all the units have been impacted, but you have losses for some part of the policies in the portfolio. And here you have the distribution of losses. You had, let's say, a series of, let's say, seven incidents here, for which compensation can be paid, could be paid. Okay, claims should be paid. And you see this is the size of the losses for each. So at the end, we see that. In this case, what will be the retention? Okay, well, the retention will be all the claims except the 2 highest claims. In other words, the reinsurer would pay 140 and 160, altogether 300, okay, which corresponds to the 2 highest claims. You see that typically this type of reinsurance, non-proportional reinsurance agreement will reduce volatility of losses, okay? It will smooth the income, okay? And it will also improve the solvency indeed, because it's a way to avoid the most severe losses, okay? So it both stabilize revenues for the insurer and also improve its solvency. Okay? Well, actually, let me tell you a case to show you that sometimes it's very tricky, even though it looks simple like this. When it's come to real life, it may be sometimes a bit difficult. I remember a case which is the Twin Towers in New York. You all remember, I guess, that terrible event. Okay? And the 2 towers fell. And there was such a reinsurance treaty, but it was not the 2 highest claim, it was the highest claim, okay? Only 1 rather than 2 here, okay? And then the question came, the 2 Twin Towers, is it 1 event or 2 events? Okay, is it 1 claim or 2 claims separate? Well, it took years and years to decide what it was, because some people were indeed arguing that it was the same terrorist attack and therefore the same event. As I said, no, there are 2 aircraft, there are 2 events, and since there are 2 events, we will pay only for 1. Okay, the biggest. You see, it took several years to decide in the end that it was a single event. Okay. Well, so the retention, sorry, there, as I said, the green part will be kept by the reinsurer. Okay, so now I hope you have a good understanding now of what reinsurance is all about. What are the functions of reinsurance? There are many, as you say, and the different types of agreements. Even if my presentation was not complete, I gave you the main categories, okay, of reinsurance treaties or let's say facultative reinsurance agreements. Okay. Now, the next question, and it is an important point. If you want to understand the balance sheet and the accounts of insurance and reinsurance companies, how are you going to account for reinsurance? Okay. Normally, I ask you to do the job in class, indeed, and considering the condition under which we are working today, that's not quite easy. Okay. So let's look at this. You have a balance sheet before reinsurance. Equity 400, insurance provision 1600. So I guess you see what insurance provisions means. It is 1600. By the way, is the estimate of the claims to be paid, considering the policies which have been sold to policyholders. Okay. So the total equity and liability would be 2,000, equity plus insurance provision. And let's assume, for the sake of simplicity, that there are no operating assets or liabilities, that all this money is invested on the other side of the balance sheet. Okay, so total invested is 2,000, which gives total amount to simplify. Okay, let's assume that there is a reinsurance treaty which is proportional 20%, meaning that 20% of the premium will be transferred to the reinsurer, but the reinsurer will also cover 20% of losses. In addition to this, if you have 20% transferred to the reinsurance, it means that the reinsurer should have a share of the premium so that he can accumulate the funds in his balance sheet, which corresponds to its own insurance provisions. In other words, if there is a 20% proportional reinsurance, it means that part of the debt, which is 1,600, what we estimate to have to pay in the future, 20% of that, 320, should be as insurance provisions in the balance sheet of the insurer. Okay, of course. And normally, the funds should be transferred so that these funds would be part of the asset of the reinsurer. Well, it's not always like this, because frequently, reinsurance companies, they may not have the expertise and the willingness to manage themselves these funds. So we assume here, if I assume it, it's just because it's a common practice, that 40% of reinsured provisions, okay, are transferred to reinsurer. In other words, for 40% of the provisions that normally would be in the balance sheet of reinsurers, 40% of this, the fund which corresponds to this, will be kept by the reinsurer. But the rest, 60%, remains as part of invested asset with a ceding entity with an agreed return for the reinsurer. In other words, for part of the money will not be transferred to the reinsurer. It will be kept by the insurer, and the reinsurer will manage the funds for the reinsurer and pay him an agreed return. Okay? So the question is, considering this type of agreement, which is typical of reinsurance treaties, let's build the balance sheet after reinsurance for this company. So a straightforward intuitive answer would say to be equity is still 400, and insurance provisions now fall down to 1240. Okay, this is typically what you answer when I ask the question how to handle that, because since 20% is transferred out of the company, so you can reduce your insurance provisions, okay, to keep only 80% of these provisions, which is your retention rate. Okay? That's a straightforward, intuitive answer, but, well, forget it. Forget it. Why? Because legally, the direct insurers remain fully liable toward their policyholders. You have sold insurance policies, okay? And based on this, your estimate is that you may have to pay 1,600 of claims. You remain fully liable for that. Policyholders, they don't want to know about reinsurance. It's not their problem. That's the problem for the insurance company. But the only entity they are in touch with is the direct insurer. The direct insurer remains, whatever he is doing after, remains fully liable towards its policyholders. It means that legally, you need to keep 1,600 as insurance provisions in the balance sheet of the direct insurer. We need to take account of reinsurance in another way. So what are we going to do? Here you have the answer. Equity 400. Underwriting provisions, equity 400. Underwriting provisions 1,600, you don't reduce it. You remain fully liable towards your policyholders. Okay? Share of invested assets owned by reinsurers. That's also a debt. Normally you should transfer the share of the premium to the reinsurers so that they can have a fund to invest in to, let's say, match their liability because they have accepted to reinsure part of the risk. But some reinsurers would say, we are not well equipped to manage our assets. So please keep the money with you. Keep the money with you, and you will pay a return to us. Manage the funds for us and pay us a return, a rate of return in return for it. Okay? So, and we have seen that 60% of the provisions that normally should be the funds that should be transferred to reinsurers are kept by the insurers. So 60% of 320, 60% of 320 gives 192. Okay? So what are the invested assets? The invested asset, you had 2,000. Now you have less. Why? Because 40% of reinsured provisions are transferred to reinsurers. So 128 is the share of the fund that needs to be transferred to reinsurers because they want the money and they want to manage the money themselves. So you see the 320, 20% of 1,600. Part of it remains in the asset 192, and the other part is transferred to reinsurers 128. Okay, so that the invested assets are now only 1872. How are you going to account for reinsurance in terms of coverage? Well, we said that you maintain your underwriting provisions because the insurer remains fully liable toward its policyholders. But reinsurance means that the reinsurer is committed to pay you 20% of the claims. Okay? In other words, the reinsurer has a liability towards you. He has a liability to pay an estimate of 320. Okay? So you will take into account this within the assets. So rather than having a minus in the underwriting provision, you will account for it on the asset side with a plus, which is 320. 320 can be seen as a kind of reinsurance receivables. Okay? This is what reinsurance are expected to pay you, assuming that the cost of claim will be 1,600. Okay? So altogether, you have a total of 2,192 of assets and liabilities with this type of accounting. Okay? So that's the accounting approach. This is how the reinsurance would affect the balance sheet of insurers. I hope you have understood this, because it's an important point from a legal point of view, but also to understand the accounts of insurance companies. Okay, so I have finished with the first part of reinsurance, which has to do with the traditional reinsurance, as we say typically. Okay, but I mentioned also in my introduction that now there are tricky situations to be faced because of the emergence of catastrophic risk for which we don't have much knowledge. You know, what about the probability and the impact of the climate change in terms of natural catastrophe, or how to anticipate, how to value the cyber risk and all these things. Okay, so we are entering a new era of risk financing. Okay, reinsurance is definitely not enough. So there are new solutions needed. And the new solutions, as always, you know, what is all solutions which are not traditional. It is true in investment, for instance. You have heard of alternative investment. The expression, you are probably familiar with it. Alternative investment is, for instance, investing in commodities, investing in art, investing in bitcoins now. Okay, all these are alternative investments. Well, now in reinsurance, on the insurance market, you have alternative solutions, which are called alternative risk transfer. This is a domain of ART, which is a new era, which corresponds to a new era of risk financing, which I will now introduce, which is interesting. Actually, it refers to, when you look at ART, it refers to two elements. First of all, risk transfers through alternative risk carriers. And in particular, you just realize that particularly large industrial, retail, or large multinationals, okay, they tend to have their own insurance and reinsurance system, okay? In other words, it's a complement to the traditional insurance and reinsurance organization. You have now the penetration of this market by the big, large multinationals themselves, because they find there a way to optimize their insurance purchase. And not only that. So we will see that. The other point is the use of new financial instruments. Okay, you know, why do insurers need reinsurance? One major reason, the first one I have mentioned, is their capacity is limited. Then you can go to reinsurance. But reinsurers are also limited, as we said. Okay, so we have to push the limit further up. And the idea is that you have on the capital markets some people who are ready to take risk. Some are desperately looking for risk to get a good return. Okay, you know, all these pension funds, all these hedge funds, all the private equity firms, and all that. You've heard of all these things, you know. Well, and they found in insurance maybe a good opportunity for investment, but not in the traditional way. Okay, in other words, we have seen the emergence of new types of instruments, what we call insurance-linked securities, which can be traded on the market, and which will be instruments that will be a kind of substitute for traditional reinsurance. The typical case for that is what we call CAT bonds. CAT stands for catastrophe bonds. Okay, so I will present these two things. First of all, the development of, let's say, insurance and reinsurance captive from large multinational companies. And you'll see that most multinational companies now have their own insurance system, okay? And then after that, the use of new financial instruments. So let's look at captives. A definition: a captive is a fully owned and controlled subsidiary, okay? We use this word captive, but you could say it's a subsidiary with an insurance activity fully owned by a group, a large group. Okay. So this captive, so fully owned subsidiary, it can be a brokerage captive, an insurance or reinsurance captive. Let's say a few things about a brokerage firm. for the brokerage firms, you see, you know what a broker is. Broker, usually there is a difference to be made between brokers and agents. Okay, an insurance agent, for instance, would sell the policy of one specific insurance company. For instance, if you are an agent of Allianz, which is a big European insurance company, you sell policies designed by Allianz. And Allianz is committed by your action toward the policyholders. Okay, so the agent is representing an insurance company. Okay, now, and that's more the case for agents mostly intervene on the individual market, on the retail market, as we say. Okay, but if you are a large firm or even a medium-sized company, you may like to have a specialist, someone who would be able to find the best solution for you on the market. And this is the role of a broker. A broker is serving the client, not the company. The client, typically a small size or big size company, is wishing to find a cover on the market, a policy that fits well with its organization, with its need in terms of risk exposure. And therefore, the broker is there to contribute to the design of a policy that would fit exactly to the needs of the client. Okay, so he's representing the client, and the broker would try to find the best solution on the insurance market. Well, so indeed, you have to pay brokerage fees, but there are some type of activity. Let's take the oil and gas activity, for instance. Those who are intervening in very tough conditions, for instance, drilling sometimes 3,000 meters under the sea, with digging then a bit further, 1 kilometer through a layer of salt before they reach oil and gas. So these are very tricky business with, let's say, what we call frontier technologies, which are not always quite proven. So these are very risky. So, and they need insurance indeed. But do you think they would find outside their company the specialists who would be able to design the best policy for them? Well, those who have the deepest knowledge of their risk are in the company. They don't need a broker to tell them what they need. They know exactly what their risks are. They know better than any outsider what the risk is. That's why should they pay fees to external brokers who know less than they do inside the company? So that's a good reason for having an internal brokerage firm, okay, a captive, where you will internalize the fees. You will save the fees rather than paying fees to an external entity. Well, you have the specialist inside the company. Your risk management team will take care of that, okay, and they will get the fees. You internalize the fees, okay, rather than paying that to outside people. Okay, so it's easy, and I don't need to insist about brokerage captive. That's rather natural. Now, the other way around would be to say also, but after all, we are so big. We have such a financial capacity. We can raise money on the capital markets and so on. So do we need insurance at all? Maybe we can have our own insurance firm, okay? We can be our own insurer, and eventually we will not keep all the risk with us because we will have access to the reinsurance market. As an insurance, if you have your own insurance company, then you can have access to the reinsurance market after that. You keep your retention rather than having it inside the company, you have it inside your insurance company in your subsidiary, which may have an advantage from a tax purpose, okay? And then it's also interesting because as an insurance company, you also have access to the reinsurance market, which is very often seen as a wholesale insurance market where the cost of insurance is lower than what it is in direct insurance. So having your own insurance company is a way to reduce the cost of your insurance, okay? You have the expertise, you will define the policies you want, okay, with your specialist inside the company, and you will define what is your retention level, and you will have access to the reinsurance market. Well, but there is a limit to that. The limit is, let's keep the example of oil and gas. Let's take the case of a company like Total, I mentioned this because, you know, it's a big oil and gas French company. And as far as I know, I don't know if they're still in Vietnam, but they did operate in Vietnam. So let's assume that Total has a project in Vietnam running a company locally, okay? Let's say a refinery or something of that kind. If they want to buy insurance for their refinery in Vietnam, if they have their own insurance company, let's say in Luxembourg, well, they cannot use it to cover a risk in Vietnam because they don't have the license to operate in Vietnam, okay? And that's why, rather than having their own insurance company, global multinational groups, they like to have a reinsurance captive rather than an insurance. Usually they have both. They may have one or two insurance companies localized in specific countries, typically for reasons we'll see, tax haven, but they will also have usually their reinsurance captive. Why? Because the reinsurance captive would give them an access to their risk wherever they are in the world. Okay, as we'll see. And this is what I will describe. Okay, so as far as the motivation are concerned, I will get deeper into the description of how it works. But note that the main motivation, first of all, and it starts with the brokerage firm, the efficiency of the risk management organization. You internalize also the fees. You can you develop your own solutions in terms of insurance, which you need. So you have a bespoke and extended insurance solutions, rather than going on the market to take typical policies which may not fit with your needs. You define your own needs. You define your own insurance policy which you want, and it fits perfectly to your needs. You have an access to the wholesale insurance market, and you reduce your insurance costs. And last, but not least, and that has nothing to do with insurance to a certain extent, but at least it allows you to optimize your international capital flows and tax optimization. Okay, this may be a kind of additional argument which has not much to see with insurance, but which is nevertheless, I would say, one of the major reasons for developing reinsurance captives in particular. Okay, so just some details. If you want to know more about captives, you also have a reference here. So you see, I didn't send you just a remark. I didn't send you a list of readings. Okay, I will provide you at the end of this course a few readings that might help for your assessment. Okay, but each time I'm talking about a topic, on the slides you find the web links. You know, so if you want to know more about captives, here it is. Okay, so just to be precise, I just indicate the different types of captives that exist. Single parent, it's wholly owned subsidiary of parent company structured to meet individual company needs and so on. Multiple parents, you may have it jointly owned by a group of companies in the same industry. For instance, you can have a joint company in the oil and gas industry where they are focusing on the same type of needs. Okay, so they put together their needs. Heterogeneous, jointly owned by companies of similar size but in different industries. It may be good if companies are too small to have their own captive, then they can come together, okay, even if they are not in the same industry, and they would have their common type of service. Rent a captive for companies in the same industry that are not large enough to form their own captive but want the opportunities that owning a captive provides. Do not pull risk, but instead pay captive owner a fee. So you develop a kind of captive, which is, we call it rent a captive. And a segregated cell, similar to a rent a captive, where owner of the cell facility owns the insurance license and runs the day-to-day management. So it's a way to externalize the service. It's still your captive, but you have specialists running that. These are people from outside, and you rent their service to a certain extent. Okay, so these are different types of captive. But I will mostly focus my description with a single parent captive, which is the easiest to describe. Okay, so we can look at the typical structure of a captive, but it takes a bit of time, and I'm just looking at my watch, so I'm wondering if, and I will suggest that we take a break now, a 15-minute breaks. Maybe it would be the best way to do it. $15. I think it's the right time to do it because the next slide takes a bit of time. It is a bit complex. That's why I want to let you take a break and breathe a bit and maybe have a coffee. Café den. I'm going to have a café den. Okay. See you. 15 minutes. Ça descend des habits qui sont là. Okay, so I am back, and I suggest we start again. Just a remark before I start again. I just realized that some of you probably wanted to ask question because you have some hand raised. But when I talk, when I present, I have my PowerPoint session in front of me, so I don't see your messages and I don't see your signals. So the only way, and I would love you to do that, is to just interrupt me, to take your microphone and ask a question if you have any. Don't hesitate to interrupt me, okay? Because it's a bit of a pity, but I can't see the way I'm teaching with the slides in front of me. I can't see your signals and your question, if any. Okay, so don't hesitate to interrupt me with your microphone, please. So let's come back to our presentation. So I remind you the different types of captives, and now I am going to present how it's organized precisely. Okay, because it's now a full business which has been developed in particular by insurance and reinsurance companies, because they find here a way to generate fees rather than taking risk, because behind this captive development, you need to have some expertise in terms of managing an insurance company. And that is something that insurers know well. So behind this captive development, you also have the contribution of insurers to launch the captive, to help companies to have their own captive, okay? So let's imagine the parent company, let's say in this part of the world. Could be in the US if you like. And, well, they are going to launch a reinsurance captive in another part of the world. We'll see. I will indicate the location later on. Very often, to be clear, it is launched in a tax haven. Okay, so the parent company would invest a bit of capital to launch the insurance or reinsurance captive. And would the captive make profits? Well, then in this case, the captive could pay dividend to the parent company. Now, let's assume that there is a project in another part of the world. It could be in Africa, if you like. It could be in Vietnam, if you like. And, that's a place. Let's assume that our company is doing business in Vietnam. Okay. Well, so there is a project in Vietnam. There is an entity. Let's say in the case of Total, I took the example of a refinery in Vietnam, and Total would like to provide insurance to its subsidiary, its refinery plant in Vietnam. Well, Total cannot directly insure its project in Vietnam because Total, even if they have a reinsurance or an insurance captive, they don't have the license to operate in Vietnam. So they need to find a local company to work with them. And they will find what we call a fronting insurance company. It could be, just an assumption, of course, it could be Bao Viet in Vietnam. Okay? They could take Bao Viet as a fronting insurance company. What is a fronting insurance company? A fronting insurance company, first of all, is a company which has a license to operate in the country where the risk is located. In this case, in Vietnam, and Bao Viet could be the fronting insurance company. Okay, so you have the definition down there on the slide. A fronting insurance agreement: the local insurer underwrites a policy to cover a specific risk. In other words, the fronting company, let's say Bao Viet, would provide insurance to Total in Vietnam, okay, but then cedes the risk to the reinsurer. In other words, the fronting company would insure the risk, but reinsure the risk after that with the reinsurance captives. Okay, so the risk is not kept by the fronting insurance company. In other words, when you look at the scheme, the parent company would pay a premium to the fronting insurance company, to Bao Viet, for instance, but Bao Viet would immediately transfer the risk to the reinsurance captive. The risk will not remain in the fronting insurance company. And indeed, if an incident occurs, if claims have to be paid, the fronting insurance company will pay the claims to the parent company, okay? But the claims will be paid to the fronting insurance company by the reinsurance captive. So you see, the reinsurance captive is paying, and the payment goes through the fronting insurance company, which transfers the claims back to the parent company. Okay? By doing this way, it is the trick that allows the reinsurance company to cover a risk in Vietnam, even though they don't have the license to operate. And to do this, they need the contribution of a local company, which in our example would be Bao Viet. So you might ask me, why is Bao Viet doing so? I mean, they have no interest because they just transfer. No, indeed, they would receive fees for that. Not only they would receive fees, but they may have an interest in looking at this and being able to understand the policy and to gain experience in providing solutions for this type of particular risk. Okay, so it's part of their business. They would generate fees and experience, and that's why they would accept to enter into this type of deal. So you see, by doing so, you have three entities at this stage involved: the parent company in one particular country, let's say it would be France if we take Total, a reinsurance captive, which might be, for instance, in Luxembourg, okay, and the fronting insurance company located in Vietnam, where there is an activity by Total. Okay, the risk is located in Vietnam. It is insured by the fronting company Bao Viet, but the fronting company fully reinsure with the reinsurance captives. Now the risk is with the insurance captive, but the reinsurance captive may decide to retain only part of it. That's why the reinsurance captive would then transfer part of the risk to the reinsurance market. Okay. In the end, you have a kind of risk sharing between the company. The parent company might decide to retain part of the risk. Then another part of the risk would be transferred, dark blue, to the reinsurance captive, let's say in Luxembourg. And this reinsurance captive might decide to retrocede part of the risk on the reinsurance market, and this will depend on the risk appetite of the company and on the pricing also. Okay, so you see it's a rather complex scheme, okay? But, you know, it really allows the parent company to take a full control of its insurance program. The parent company will define exactly the type of policy they need, will decide where the risk should be located, whereas it should be retained by the parent company or by the captive, and what should be the contribution of the reinsurance market. Okay? Indeed, you have legal entity, in this case, which are positioned in different countries. You can have France for the parent company, you may have Vietnam for the fronting insurance company, and Luxembourg for the reinsurance, but you know, these are legal entities. It doesn't mean that there is a big physical presence, for instance, in Luxembourg. It can just be a letterbox, okay? Well, so now let's look at the evolution of the number of captive, just to show you that it's not just a few cases, but it's a general trend which you have. As of today, the most recent numbers I found is 2017. I've seen some more recent figures, but it's rather, I didn't change the graph because it's rather the same amount. It's around 7,000 captives in the world, 7,000, you see? So it starts being a significant number. Now, it's interesting to look at where it is located. Active captive insurance per domicile is still taken from the same report. And as I told you, it's mostly located in tax haven. Tax haven, well, the best place apparently for captives is Bermuda. You see, Bermuda, you have more than around 750 captives just in Bermuda. Bermuda is a very small place, by the way. So it's incredible to see the number of companies in Bermuda. You know, I saw a survey recently, and they were trying to imagine, would each company have a kind of office locally? Well, how many square meters would be needed for that, considering the number of companies and a certain size for each office? Well, even with a reasonable size, you would just realize that the full island would be covered with big towers, you know, because it would even not be enough to accommodate all these companies. There are so many there. They are just letterbox. So you have buildings with a huge quantity of letterbox, you know, which is the location for a legal entity, but there is nobody really working there. Okay, so Bermuda, Cayman, Vermont, Utah, Delaware. You know, Delaware, it's a state in the U.S. You know, all these are well-known places for tax haven. Luxembourg is in Europe, and it is still to a certain extent tax haven, even though there are some controls on it now, being part of the EU. But you see, there is typically a strong attractiveness of tax haven for these insurance captives. So why is it so? It's easy to understand. Because probably there are good tax optimization policies to be followed by this way. Okay, so now we may have a brief discussion on this because I think it's a point of interest to you. Let's talk a bit about tax optimization. Traditionally, how does it work, tax optimization? I don't know if you had a presentation about this already, but typically companies, multinational, would use what we call transfer pricing. Transfer pricing has to do with the prices which are fixed when there is a kind of transaction between two entities of the same group. Let's say, for instance, that you have a company in Vietnam, which would be a subsidiary of, let's say, an American group, okay? And this subsidiary would provide components to be assembled in the US, okay? So let's assume that the tax rate is lower in Vietnam than it is in the US, okay? So what would the group decide? They would decide to sell the component from Vietnam at a high price, Why? Because by doing so, it will reduce the profit in the US and increase the profit in the Vietnamese subsidiary. Okay? Well, and by doing so, well, they would be reducing their global tax because they would pay more tax in Vietnam where the rate is lower and less taxes in the US where the rate is higher. Okay? So now, maybe you can do better. You can do better because you can have, for instance, a kind of company entity located in Bermuda, where you have a tax rate which would be 0. In this case, the Vietnam subsidiary would sell to the entity in Bermuda, and the entity in Bermuda will sell back to the entity in the US. In Vietnam, you would sell to the entity in Bermuda at a very low price, so that you will have no profit in Vietnam. And then the company in Bermuda will sell back to the US at a very high price, so that they will have no profit in the US. All the profits then, because the entity in Bermuda is buying cheap and selling at a high price, all the profit is there with a tax rate which is 0. This is the basic principle of tax optimization. Okay? And it's a problem, as you probably know. And there are lots of discussion about this within the OECD to try to change this, because it is indeed at the detriment of public finance. Okay, and there are many countries with public deficits that suffer from it. And one reason for this is that there is a huge amount of taxes which they don't collect because of this tax optimization, which is systematically developed by large multinationals. Okay, so, well, but tax authorities, they have learned to deal with that. And now they have some practices that kind of limit the possibility to optimize tax and to develop the scheme which I have presented. Because, for instance, if you produce a component in Vietnam, a physical component which will be assembled in the US, well, if you sell cheap, your tax authorities would say, well, this is not a fair price. The price is much lower than what it should normally be. Would you cover your cost and so on and make a normal profit? And therefore, the tax authorities in Vietnam could absolutely correct the thing and say, well, we will decide that normally the price should be this one, your profit should be this one, and you should pay this amount of tax. Okay? In the US, the US tax authorities might have the same approach and saying, well, what you have paid there from your subsidiary in the Bermuda is not a normal price. It is overpriced, and we consider that you have hidden some profits and we tax you there. So you see, now you start to have some reaction from tax authorities. Now let's come back to insurance. The transactions there concerned risk. So if you produce a component or a car, for instance, the tax authorities can easily verify whether the price fits with the cost of producing, because you can identify clearly how much commodities you use, how much time you need to produce, and so on, and you can calculate reasonably the cost at which you produce and what should be a normal profit. But when it comes to insurance, how can you say that a risk is overpriced or underpriced? It's very difficult to control that. So insurance is a field where you have a lot of possibilities to transfer capital around the globe, through these captive systems, because nobody can say at any time that you are overpricing or underpricing, because when it comes to risk, and particularly risk which are very specific, okay, you have no reliable market price that you can take as a reference, okay. Most of the time you have, particularly for tricky activities like in the oil and gas and so on, where they use sophisticated techniques with each case being very specific, you cannot say, well, this is the right price, this is a fair price. It's very difficult to say. Nobody can say. Even insurers cannot say that. What is a fair price? Okay, so it means that this is an activity where a lot is possible in terms of tax optimization and transfer of funds from one place to another on the globe, which explains probably to a certain extent the success of captives and the growing number of captives. And when you look at where they are located, there is no doubt about it. Okay, so probably one of the major motivation for captives is not only the optimization of the insurance program. It is true that it makes sense because it's a way, obviously, to internalize cost, to reduce the cost of the insurance program, but it also contributes a lot to tax optimization and therefore to improve the financial performance of the group. Okay? Well, so I finished with this first part of the ART, alternative risk transfers. I told you that there are two approaches, specific carriers like captives, which we have seen. Now the next step is to look at something totally different, new instruments, okay? ART, with new financial instruments which can be used as a substitute for traditional reinsurance. And I will focus on one typical example, which are the catastrophe bonds, the so-called cat bonds. And they are so-called risk-linked securities, okay? Securities meaning that these are traded instruments, and therefore it opens the possibility to use the capital markets where you have risk takers to transfer part of the risk. So cat bonds are risk-linked securities that transfer a specified set of risk from the sponsor to investors, okay? We find investors who are going to buy these securities, and by doing so, they will take the risk that insurers are willing to transfer to the reinsurance market, insurers or large companies, which can also use this instrument to reinsure their risk. They are often structured as floating rate corporate bonds whose principal is forgiven if specified trigger conditions are met. Let me try to give you a very, very simple example. Let's assume that you are in the oil and gas business. You are an activity of drilling and exploration and production in the Gulf of Mexico, deep sea drilling, okay? I take the example of the Gulf of Mexico because very often you have storms in this area, you have hurricanes. And the problem with these hurricanes, they might destroy your facilities, your equipment, all of a sudden, you know. So that's a tricky kind of risk, okay? That insurers may not like to take, okay? So when they have this type of risk to deal with, well, they are often looking for reinsurance solutions. Or even if you're a company like BP, ExxonMobil, and so on, well, they might decide by themselves to find solution to transfer this risk on the market, on the capital market. And they would use this. So typically what they would do, they would say, well, in case of a hurricane that would destroy part of our facility, we would like to have a kind of amount of money or lump sum given to us as a compensation, let's say $500 million, okay? So they would issue bonds for an amount of $500 million, okay? And they have the money. Now there are two solutions. Either there is nothing happening, no hurricanes, no storm, nothing is destroyed. Well, they give back the money, they repay the capital at maturity, and they pay the coupon with it, okay? Second possibility, the hurricane come in, everything is destroyed. So what happened? They keep the money. They don't repay, okay? They don't repay. They may sometimes pay the coupon, but they are not giving back the principal, okay, at maturity. They keep the money as a compensation because the hurricane has occurred. So that's what it is. So you might be a bit surprised because probably when I tell the story this way, you will probably have a question in mind. Who is stupid enough to buy such a bond? You know, you have the risk of losing everything. You have a default risk, which is huge. If the hurricane occurs, then you lose your money. Even though the coupon might be comfortable, well, still, okay? Well, actually, this approach to the interest of cat bonds is wrong. You need to have a portfolio approach. And if you have a portfolio approach, if you are a portfolio manager, you might have a different look at it. Why? Because the risk you are taking is not correlated. The risk you are taking can be diversified away. It is not a systematic risk, okay? It is a specific risk that can be diversified away because it is not correlated with the markets. okay? And this lack of correlation makes it quite interesting in terms of diversification. And don't forget, for instance, that indeed you shouldn't invest all your money in one such bond. But if you have a bit of it in your portfolio, it is totally decorrelated from the market. Okay, so that's a good instrument for diversification. And also, even if you buy catastrophe bonds only, you can diversify a hurricane in the Gulf of Mexico with the risk of earthquake in Japan, with the risk of flood in central Vietnam, with the risk of any other natural catastrophe somewhere else in the world. Okay, so you can have a geographical diversification, a diversification in terms of event, storms, earthquake, floods, and so on. And all these elements are not correlated. There is no correlation between the risk of an earthquake in Japan and the risk of a hurricane in the Gulf of Mexico. Okay, so you see, because it's not correlated, these instruments are quite interesting for portfolio managers. So indeed, if you think of your position investing the little bit of money you have in this type of asset only, well, that would be wrong. That wouldn't be a good strategy. But if you are a portfolio manager with a huge amount of money to handle, it can be a good thing to have. And I will show you some numbers later on. Well, specialists such as pension funds managers, they manage huge amount in terms of hundreds of billions of dollars. They consider that investing about 2% of their assets in such instruments is a good thing to do. Okay, so 2% when you handle $100 billion, you see that it's about $2 billion. So it's not that bad. Okay, so what is the interest of cat bonds? So I will explain more precisely how it works, and I will take an example of a cat bonds which had been issued not so long ago, actually for the pandemic. So it's a very up-to-date example. So the interest of these instruments is you find a solution to cope with limited reinsurance capacity. It provides solutions for risks that reinsurers are not comfortable with because it might go beyond their capacity. So the market would provide this extra capacity needed to find solutions. A risk transfer through the market may not require equity. I mean, the hedge funds, for instance, investing in this type of instruments, they don't have the same constraints than insurance companies or banks, I mean, to invest and to take this risk. So it's a way to increase the reinsurance capacity. What are the limitations? Indeed, lack of reliable data. Who can really predict, give a serious value to the probability of an earthquake in Japan in the year to come? We know that it's quite possible, but giving a probability is a kind of best guess, but nothing else. And therefore, it's difficult to price. And there is a standardization issue. It's good if on the market you have a kind of standard instrument so that it creates liquidity. Okay, and because of this lack of standardization, each issue is unique to a certain extent. Well, the market tends to be illiquid, which is the other limitation. Okay, so it's a good solution. It's not a perfect solution just because you have this lack of data and also because you have a lack of liquidity. But let's see now how it works. This is also a graph which reminds you the increase in number of natural catastrophes over the last, this is already a rather old document, but if you remember, I have shown you a graph in my introduction when I talk about natural catastrophe, and you remember probably that there is a regular increase in the frequency of natural catastrophe as well as you can see here in the severity. Well, and I will take as an example an instrument that was issued in March 2020, okay, a pandemic cat bonds, which has been triggered at that time. It was issued a bit before, but it has been triggered in 2020, of course, because of the COVID-19. It was issued by the World Bank to cover the risk of pandemia for a group of African countries. Okay, so I will take this as an illustration for you to see exactly how it works. So now I give you I have tried to, in a simple way, to explain how cat bonds would work. Okay, you issue bonds, and then you don't need to pay back if the event occurs. Well, but it's not that simple. I mean, you have a whole structure. It's a lot of financial engineering behind that, which I'm going to explain now. Well, first of all, you have the seeding entity. The seeding entity is where the risk is located. It might be, we call it a sponsor sometimes. It can be an insurer, or a reinsurer who has provided an insurance in the first place to customers, but not willing to keep the risk. Or it might be even a company, like, for instance, in the oil and gas. It could be Total, it could be BP, it could be ExxonMobil. Well, they could directly use these instruments to insure, to cover their catastrophe risk. Okay. On the other side, you have investors. These are entities ready to invest money in such instruments. So you need to launch a SPV, which will be in charge of issuing the bond. Okay. So this is the issuer. The issuer will, the investors will pay for the bond. They will buy the bond. Okay. And the seeding entity will pay a premium. So I will explain that more precisely. So first of all, the investors, they are buying the bond. And later on, if there is no event, they will receive a coupon payment. Okay. And the coupon payment is, well, a return, which is usually a return on collateral. The collateral is where the money raised is invested. Okay. And it is invested in a very safe portfolio to make sure that the money will be available in case. But indeed, because investors are taking a risk, when you invest in such an instrument, you take a risk, so you deserve the risk premium, which is what we call a spread. And the seeding entity will pay the spread only. Why? Because once the funds have been raised, the investors have paid to get the bond, to be the owner of the bond. Okay? Well, the cash proceeds will be invested in a collateral account. Okay? And this account will provide a return. So in other words, once the funds are raised, they are not going in the balance sheet of the seeding entity. They are invested very safely in a collateral account. And you get a return from that. So you see, the investor will receive a coupon payment, okay, which is the spread, which is paid by the seeding entity, like an insurance premium, and the return on collateral, which is what they get from the investment of the fund in a safe portfolio. Okay. Now, if when needed or at maturity, you can have the liquidation of assets. Okay. And this liquidation of assets will be paid to the investors if the accident has not occurred. If it has not occurred, then there is no compensation to be paid to the seeding entity. In this case, the money will come back to the investors. But if the event has occurred, well, it will, the money, rather than going to the investors, will go to the seeding entity as recoveries, as kind of compensation for the damage to which the seeding entity was exposed. Okay? So you see, it's a rather complex structure. Investors will invest money. The money is invested in a very safe fund. This contributes to provide a risk-free return, if you like. Okay? But since there is a risk, you need, the coupon will also include a spread, and the spread is paid by the seeding entity. And you see that the spread is comparable to an insurance premium. If you look at it, the seeding entity is paying an insurance premium, which is the spread, which will be added to the risk-free rate obtained from the collateral account. Okay, so this is a bit complex, okay? But it is necessary to make sure that the funds remain safe. You know, you cannot imagine a cat bond issue with the cash collected from the investors to be in the balance sheet of the seeding entity, because it would be at risk. So you need to invest the cash collected from investors in a safe entity, which is a collateral account, typically a money market fund, with a very safe exposure. Okay. Well, so now let's look at if you have understood this scheme, there is no question on that. I would have liked to hear a question from you, but it seems that you're comfortable with that. So I'll leave you with it. Again, you have some web link here. If you go there, you will find all types of details about what I'm talking about. Okay. Here you have some data concerning the progression of the issuance and the outstanding risk capital. You see there is a kind of accumulation and it is increasing. Okay. 2019, you have slightly decreased, but it's also linked to the, you had a drop in 2008, indeed, because you had a financial crisis on the market. And there was kind of suspicion about all type of new instruments. That's why, you know, you have in 2007, between 2007 and 2008, a dramatic drop in the issues. Okay, but it started again, and it is increasing, and 2019 is not quite a relevant year, as you can imagine. Okay, but it is still growing today. Okay, so now one question is, when do you decide that the event has occurred? It's one of the difficulties. For instance, I took the example of a storm or a hurricane in the Gulf of Mexico. Okay, well, how will you decide that the hurricane or the storm has occurred? Okay, you need to have a kind of objective element, reliable element that will tell you, give you an indication on whether the catastrophe has occurred or not. For instance, in the case of a hurricane or a storm, it would be a parametric trigger. Okay. For instance, if you read a parametric trigger, the parameter will be the wind speed, for instance, for a hurricane bond, the ground acceleration for an earthquake bond. Data for this parameter is collected at multiple reporting stations and they entered into specified formula. For instance, you may have different places there where the wind speed is measured and you take the average. And if the average of the wind speed is above a certain threshold, then you decide that the hurricane has occurred or the storm has occurred and you trigger the bond. That is, in this case, the money is transferred to the seeding entity. Okay. If the speed was below the threshold, then the money comes back to the investors. So you have different type of triggers. I gave you the example of parametric. I'm not going to read all this. I gave it for your information. But you know, it's important to see that this is one of the difficulties in the cat bond issue, to define clearly what the trigger should be, so that you should avoid any kind of ambiguity on whether the catastrophe has occurred or not. Well, so the trigger type now, you see, indemnity is the dominant type of trigger. So we can look at what it is. Indemnity triggered by the issuer's actual losses. Okay. So the sponsor is indemnified as if they had purchased traditional catastrophe reinsurance. Okay. The issuer of you look at the size of losses, and if the losses exceed a certain amount, well, then we consider that the catastrophe has occurred. Okay. If the layer specified in the cat bond is 100 million excess of 500 million, and the total claims add up to 100 million, then the bond is triggered. Okay. So you have a kind of amount, and if there is a threshold, if you have a size of the loss which is higher than the threshold, then it's triggered. That's the most common, as you can see, indemnity. Okay. Well, I like this this one because it shows that you may have cat bonds in very different types of situations for many different types of catastrophes. You see, Japan earthquakes, US earthquakes, healthcare, Healthcare, well, it's in case of a kind of a pandemic to a certain extent. If you have an excess of expenses in healthcare for certain insurance company, it might be a problem. European windstorm, extreme mortality, that's also the case for life insurance companies. You know, life insurance companies might be concerned with extreme mortality for any reason, okay? And that would be a catastrophe for the company, and that's why you have some cat bonds for that. US multi-peril would include storms as well as earthquake and the like, as flood. International multi-peril, it can be anywhere. Japan typhoon. Longevity is for pension funds. For instance, if people live much longer than expected, then they would have to pay pensions for a longer period of time. Storm surge, Turkey earthquake, you see that's very localized. And there is a funny case, if you look at this, lottery winning risk. You know, if you organize a lottery, you may lose a lot of money at the end if your customers are too lucky. Okay, so you can find a way to cover yourself through a cat bond with the case of lottery winning risk, Caribbean multi-peril, US property catastrophe risk, and so on. So you see when you see the wide variety of cases, you see that even with a portfolio of cat bonds, you can benefit from diversification, because a Japan typhoon has nothing to do with a US earthquake. It's not correlated at all. Okay, so due to this absence of correlation, you can mix a portfolio of cat bonds and have a good result at the end. Of course, you will lose on few of them, but globally, you may have a good return. Okay. Well, actually, for instance, companies are working, that was in late 2019, on cyber cat bond. Cyber risk, as I told you, is a major risk today. And the cat bond instruments is seen as a possible solution for insurers. They were working on it in late 2019. As far as I know, it is not yet ready because it's very difficult to find a trigger also. And there is also a difficulty to analyze also what might be the losses in case of cyber risk. Okay. Well, here a classification of catastrophe bond by capital outstanding by expected loss. A measure of the expected loss, which is a percentage of the amount of capital invested. So you see, you have a growing expected loss up to 8%. Okay, so you have catastrophes which are not too likely. The first one, the blue one, between up to 0.5%, and then it's growing. You know, and then by coupon pricing. This is for the year 2019. By coupon pricing, you know, between 0 and 2%. This is for it corresponds to indeed the bonds with the lowest expected loss. Okay, 0 to 2%, which is rather low because it's not very risky. Between 2 and 4, and dominantly it's between 4 and 6. Okay, and 6 and 8. You know, the higher the expected loss for the catastrophe, indeed, it means that the probability of occurrence is higher. Indeed, in this case, the higher the coupon pricing. Okay. So how is the coupon defined? Well, it is based indeed on the expected loss, on the probability of occurrence in particular. How do you get it? As you will see with the example I'm going to take, you have some specialist institutions which have specialized in the valuation of the expected loss for specific type of catastrophe. Okay, it is a business in itself today. The questions remain: to which extent can we rely on the numbers published or on the result of these provided by these specialists? To which extent can we count on it as a reliable data? Here you have the gap between the expected loss and the average coupon. Okay, the expected loss is, well, normally, you see, the coupon has to be higher than the expected loss. It's a kind of risk premium above the expected loss. Okay, what you can see here is that it tends to decrease. The gap between the two tends to decrease. Why? It corresponds to the fact that the market became more and more attractive. And if the market became more and more attractive, it means that investors tend to be less and less demanding. And some are warning the market, saying, well, maybe investors should be careful because they tend to be not enough demanding in terms of coupon now. And this is illustrated by the fact that you see the gap between the expected loss and the coupon is clearly decreasing. You have it here. If you want to show it more clearly, if you compare the expected loss to the coupon, this ratio is decreasing, which means that the gap between the two is decreasing. The risk premium obtained by investors is decreasing year after year. Well, it's not exactly true because, as you see, from 2017 to 19, it has increased again. And it corresponds to a period when there was a warning, really, saying that investors should look at it a bit more carefully. Okay. Well, now let's look at this graph, which, in my view, is most important. Okay. Why? Because it illustrates what I was saying. These instruments are actually very attractive for investors. Why? Because they are not correlated and they stabilize your portfolio. They are not correlated because, as I said, when I say correlation, I mean the correlation with the market trend, the financial market trend, okay, with a stock, with, let's say, the S&P or any other capital index, okay? Well, it's not surprising because the occurrence of a hurricane or the occurrence of an earthquake has nothing to do with what's happening on the stock market. You might tell me, yes, but if there is a huge catastrophe, it may have an impact in the end on the financial markets. You see, the question is right, but all the surveys which have been done looking at the past have shown that even the worst situation, for instance, the huge catastrophe which we had in Southeast the US, the Hurricane Katrina and so on, well, it didn't impact at all. It didn't impact at all the market trend significantly. Even the catastrophe in Japan with Fukushima, the nuclear plant, and which is not a natural catastrophe in this case, but it was a huge catastrophe. It had no significant impact on the stock market. Okay, so we can say that these cat bonds are really not correlated to the markets, and therefore they are good instruments for diversification. And it appears clearly in this graph. Here you have the possibilities to invest in different type of things. The blue curve would correspond to investment in equities. Okay. Or you can invest your money in bonds, and you have the details of what it includes exactly. Or you can invest in cat bonds, okay, or insurance-linked securities. You have two indexes, the yellow, which corresponds to the yellow curve, and the black curve, which corresponds to insurance-linked securities. These are not cat bonds, but very similar to cat bonds in their spirit, okay, and pure cat bonds with a cat bond index, okay, which is the Swiss Re cat bond index, okay, and you see that if you invest in shares, the blue curve, let's take the extreme, you have a big drop indeed with a negative return in 2009 because of the crisis. Then it moves up again, but a high level of volatility, and you end up in 2018 at a bit more than 100%, but you underperform the cat bond index. Okay, even if you invest in bonds, it is less volatile indeed because it is less risky than shares. Okay, but still, you have 50% growth over the period. You are also underperforming cat bonds as well as insurance-linked securities. So you see, if you look at the black curve, it grows regularly. You had a kind of a drop indeed in 2017, as it is for same for insurance-linked securities. But otherwise, except this accident around this period of 17, you see you have a kind of continuous growth, showing that the evolution of the cat bond index is not correlated with the market trend. Okay, and as far as this is true, well, then it's a good instrument for portfolio managers. Okay, and as I indicate here, cat bonds may be appealing to investors. They have diversifying qualities with an attractive historic risk-reward profile. Okay, and they, of course, offer protection to companies which have risk which are difficult to handle if you are individually exposed to this risk. Okay, so, and if you look at the financial press, you would see that pension funds, for instance, they estimate that having about between 1.5 and 2% of these instruments in their portfolio is a reasonable thing. It's good to have. Well, so now let's look at a specific case for you to have a clear understanding of how it works. So this is a World Bank pandemic catastrophe bond. Okay, you can find all the references on the web link which is here. It was issued in July 2017. Okay, so before COVID-19, before the COVID-19 appeared. Okay, so who is the issuer? The issuer, that is a kind of entity launched specifically for that, IBRD CAR 111112, okay, World Bank Catastrophe Bond. This is the SPV. Who is the cedent, the sponsor? Pandemic Emergency Financing Facility, okay, which is a subsidiary of the World Bank, actually. And this is a fund which is constituted to help a group of African countries in case of pandemia, okay? Because you know that you have a lot, the risk of pandemia is higher in Africa than it is anywhere else, okay? Actually, when it was launched, they had not in mind COVID-19, but it was more like Ebola. You may have heard of it, okay? So placement structuring agents, Swiss Re Capital Markets, will be in charge of the placement of the instruments. Is joint structuring agent and sole book runner. Munich Re Capital Markets is joint structuring agent and co-manager. GC Securities is co-manager. So you see, in the structuring of the instrument, and you need some specialists and how to issue and to make sure that it will be sold to the market, to investors. So you have the specialists in finance which are there, with name which you know well. But you see, you find insurers there, not only securities firms, but Munich Re and Swiss Re are two major players in this market because they have the expertise. In other words, now what insurers are trying to do, it's quite interesting because you had the same phenomenon in banking. Insurers are considering that now this very severe risk, they won't take them because they don't have the capacity for it, and they have less and less the willingness to do so. Why should they bother with taking their risk in their balance sheet, this type of very difficult risk to handle, whereas there are some investors in the market who are ready to take this. So rather than taking the risk, they provide the financial engineering service, and they get fees for that without taking the risk in their balance sheet. The risk is transferred to investors. But it is a business opportunity for insurers, indeed, and reinsurers. So now, how to value the risk? How to assess the expected loss, for instance? Well, you have a risk modeling, which is provided by a specialist, AIR Worldwide, which is one of the most well-known institutions providing evaluation of expected loss for catastrophes. Okay. The type of risk, the peril covered is the pandemics. The size, 320 million. That is the amount of money which will be raised and which will be made available to the Pandemic Emergency Financing Facility if the risk materializes. Okay. The rating is not indicated here. Okay, there is no rating provided. Okay, because it was a kind of private issue. Well, I mentioned to you that these securities can be traded on the market, but because they are not so liquid, actually it's more and more private issues. You know what a private issue is? It means that you have private investors investing in these securities which are not then traded on the markets. Okay, and date of issue July 17th. So now 320 million is the size of the issue, but you can have several tranches. Again, it's a way to propose to the market different class of risk. Investors might to take less risk than others. Okay, indeed, if you take less risk, you have a lower return. So there is a class A tranche of note, and it was priced to offer 225 million of notes to investors with a coupon of 6.9%. Okay. So there is a remaining portion. You know, the total amount is 320. So 95 million are missing. They are part of the class B. It's a riskier tranche priced with a coupon of 11.5%, much higher coupon. You know, if you compare to what I have shown before, you see the coupon is rather high, but also because the risk is seen as being rather high. So, you know, the class B, what does it mean? It means that if there is a bit of money needed, the first to be called for the payment will be the investors of class B. You know, there is the idea that you may not need to raise to capture all the funds because it may depend on the amount of money which is needed in the end with the size of the catastrophe. Okay, in this case, if only a bit of money is needed, only class B would be concerned. Class A will come after if the pandemic expands and more money is needed. Okay, so class A is less risky because they are not called for the first tranche. You know, they are not called for the first payment. You know, and they will have to pay only if there is a need for additional money. Okay, so you see, it is to this extent less risky. So who are the investors? You have dedicated catastrophe bond investors. Okay. So specialized, it can be kind of hedge funds specialized in this. Endowments. These are, you know, large institutions with a lot of money in hand, and they need to invest this money for the profit of the owners. Asset managers and pension funds, as I told you, they are also interested in this. Distribution by investor location, you know, it's mostly from Europe. Okay, it's probably because you have some connections between Europe, a lot of connection between Europe and Africa traditionally, and that's why Europe was more a contributor. Okay, so what happened? The pressure is rising on the World Bank pandemic catastrophe bond transaction as the novel coronavirus, COVID-19, spread internationally and the number of deaths in certain countries around the globe nears the trigger point. You know, it was an indemnity trigger, okay, or a parametric, sorry, in this case. The reference was the number of deaths in a group of countries, which was concerned by the ceding entity. Okay, in March 31st, which was the point at which the final trigger condition was met and the growth rates went positive. The IDEA, International Development Association, countries, you know, this is a group of countries concerned, counted for less than 1% of the global coronavirus case load, which we understand was approximately this number of cases. So we are close to the trigger, okay? April 2020, cat bond is triggered. The payout will consist of this amount, in other words, million from the Class A pandemic cat bonds. In addition, 100% of Class B. So Class B was fully called, okay, and Class A was partially called for the payment, okay. So you see, so I didn't look at where we are today. I think that they have called for all the money now, but it's, you know, through this example, I guess I hope you have a clear understanding of how it works and what cat bonds are exactly and how they contribute to providing solutions to risk which are very, very difficult to handle by the traditional insurance system. Okay, so going on the market is a way to benefit from investors which are ready to invest there, and also because these risks are not correlated, you know, it makes sense to have them within portfolio to increase the level of diversification, and which is beneficial for fund investors. That's why it's a good instrument in the end. So I've just described cat bonds, but you have different types of similar, let's say, insurance-linked securities, or here you have different other instruments. I describe industrial loss guarantees. I'm not going to describe all of this. Again, this is given for your information. Well, I just mentioned the case to show you how creative insurers are. You have life cat. Life cat is like cat bonds, but it's, you know, let's go back to the example in the Gulf of Mexico with the risk of a hurricane. Well, maybe, you know, you have the early signal that a hurricane might come to your place and potentially could destroy your facilities, because it is there. The problem is that we don't know exactly how it will move. Maybe it will come to you or in another direction, and it may take few days, let's say 1 week. In 1 week, you will see where it goes. So the risk is much higher because, you know, the hurricane exists. You just don't know exactly what the evolution will be. But there is a risk that, you know, it comes to you and destroys everything. So it is not too late yet to issue a cat bond. Okay, this would be what we call the live cat contracts traded while an event is in progress. Usually a hurricane approaching land. You see, so that I just mentioned it because I find it rather funny example. Okay, you have reinsurance sidecars. Again, that is for your information. All these are yes. You have a last case which I will describe a bit more, which is totally different now from cat bonds, but which is another instrument which is part of the ART, which we call finite risk reinsurance. It's a form of insurance that specifically incorporates the time value of money. So let me try to give you an example for that type of risk. It may concern, for instance, the pharmaceutical industry. The pharmaceutical industry, among the big risks they're exposed to, is a liability risk. You know, if you launch a new drug, and if it appears after some time that some people are dying because of this, well, you may be in a big mess. Your reputation is at work, but you may have to compensate and to pay a huge amount of money. Okay, and the problem for insurers when it comes to when they have to insure this risk is that they call it a long tail risk. Why? Because they know that if the case occurs, it may take years and years before a decision is made by the legal entities. So they don't know how much they would have to pay. They may have to pay a lot. They don't know when. It may be late because it takes time. So it creates a lot of uncertainty in their balance sheet. They know it might be eulogies. They have to write provisions for that. And it's very difficult to define what are the right provisions for it, you know. And it's in your balance sheet, you know, it's weakened your balance sheet because there is this big uncertainty concerning this potential claim due to a liability case for, let's say, a pharmaceutical company, which they have as policyholder. Okay, so what is the solution then? One type of finite risk insurance, for example, an insurance company transfers its claim to the reinsurer, paying a premium that corresponds to the present value of the claims transferred. Let me be a bit more clear. So you see, you are at a point in time, you say, well, there is a case there, so I know I will have something to pay. How much? What is the expected payment, well, you can have an estimate of the expected payment. Indeed, it is an uncertain amount. Very uncertain because it's very difficult to guess exactly what the lawyers, what the court will decide, who is responsible, how much you pay, and so on. So there is an uncertainty on how much you will have to pay. There is also an uncertainty on when you are going to pay. So on this graph, I have indicated the expected payment, claim payment, as well as the expected claim payment, the date. Okay, so the date as well as the amount are uncertain, but you just have, as of today, expected value. So if you have a financial approach, you can determine the expected value, the present value, sorry, of the expected payment, considering the date at which it will occur and the amount you will have to pay at this date. Indeed, when you want to calculate this, there is a concern with which discount rate are you going to use. Okay, that's, as you will see, will be a key element in the negotiation. Because the idea of the finite risk reinsurance is to say, well, what you are going to do is to transfer the risk to a reinsurer or to any type of entity willing to take the risk. You will pay now the discounted value of the future claim payment. Okay, you will pay that, and then the risk will be transferred to the entity taking the risk, which might be a reinsurance company, but which might be also an investor. Okay, so that's why you see in this case we take into account the time value of money, because what is paid is the present value rather than the full value of the expected claim payment. Okay, so what is the problem with this type of finite reinsurance? You transfer the risk by paying immediately the present value of the expected future payment, and therefore there are two cases. The reinsurer or the entity taking the risk has two types of problems. First of all, he may have to pay more than expected and earlier. Okay, this would be the situation. If in the end, the risk taker, the reinsurer, let's say, has to pay earlier a higher amount, well, you will understand that what he received for that was not enough. Okay, so he would be lucky. On the other hand, that's why it's you have an upside and a downside. So you can see that as a kind of bet. You know, a lucky reinsurer would pay less later. If you pay less later, it means that what you have received is more than enough to compensate you. Okay, and you have made a profit there. But you are taking this type of risk actually. So the risk taken by the reinsurer is there. And indeed, depending on the risk, you will play and you will discuss with the discount rate. Okay, so if you take a low discount rate, okay, and the reinsurer will try to negotiate a low discount rate, a low time value of money, okay, typically a risk-free rate, saying, well, I don't want to take risk on that side, you know, because if I invest the money, well, I don't want to take risk with it. So you will negotiate with a risk-free rate. If you take the risk-free rate, you will take the highest possible value for the lump sum which you get at the beginning, okay? But if the risk is lower, well, maybe the seeding entity will say, well, you can invest the money on the market and get a good return. And this return is what we need to take into account to assess how much money you need now. Okay, so you see there is a negotiation with a discount rate, well, which is not always easy, but it depends on how the market, and it depends on the willingness to take risk from the reinsurer side, okay, and the willingness to cede on the ceding entity's side. Okay, so that's the way it works. And the finite risk reinsurance is very much used for long tail risk, typically when you have a liability issue. And I would say it's a way for companies to clean, for insurance companies to clean their balance sheet, to get rid of this. Okay, well, what I should add is that sometime, if the risk is really important, if there is a big uncertainty on the payment, you can have a stipulation within the finite reinsurance agreement saying that the ceding entity could partially compensate if the cost of the claims in the end is higher than a certain threshold. So you can have also a participation clause in this type of reinsurance agreement just to limit the risk due to the uncertainty affecting the level of the claim payment. Okay, you can also have a clause that would provide a partial coverage if the payment is earlier than expected. Okay, so these are ways to transfer part of the risk, and part of the risk would be kept by the company. Okay, the only difficulty after that is in terms of regulations is there are lots of discussion on how to account for this type of arrangement, this type of agreement. Can we consider the risk is transferred? To which extent? What impact should it have on the level of equity required for the company? So there are still discussions there which are a bit tricky. Okay, so I have just mentioned that because this type of new instrument, finite risk reinsurance, is more and more common. It tends to be used more and more, particularly since the capital adequacy rules and solvency regulation are becoming stricter for insurance companies. And that's why they need to clean their balance sheet to limit the amount of equity they might be obliged to have due to stricter solvency regulations. Okay. So the typical features, if you summarize, a risk transfer and a risk financing are combined, and the time value of money is emphasized in the contract, as we have seen by the discounting techniques. A limited assumption of risk by the reinsurer, okay, because the risk is only if they have to pay earlier and if they have to pay a bit more. A multi-year contract term usually, because it's for long tail risk with an uncertainty when the payment will have to take place. Explicit inclusion of investment income in the contract. That's a negotiation about the discount rate. And you may have a sharing of the result with the insured or the cedent. Okay. If you want to know more about it, here again, you have a reference. Okay. So I repeat a bit what I've said already here. So as I said, there was a bit of an issue when it comes to accounting, but that's a technical remark. I don't need to spend much more time about it. Okay, so I have finished with this part, reinsurance. Okay. I will not cover the next topic fully, but I will just introduce it before we stop today. Please, I will explain what we are going to do. You know, so far we have been talking about non-life insurance. And I have made a distinction between non-life and life for technical reasons. Because technically, you know, these two branches are totally different. In non-life insurance, that is casualty and property liability insurance, okay, you have a situation where the insurance guarantees that in case an accident occurs, it will compensate. Okay, it will pay a compensation. In life insurance, it's a bit different. You have part of it, which is insurance in case of death, which is a bit similar to non-life, because you have an event, which is the death of a person, and then a payment, which is made to the beneficiaries in case of death. Okay. Well, technically, it's a bit the same because the payment is triggered by the occurrence of an event, which is the death of a person. But the difference still, there is a difference in the sense that, you know, if you have an accident with your car, or if you are victims with a liability case and so on, you never know how much you're going to pay. And as we said before, you don't sometimes even know when you will have to pay. In life insurance, in case of death, the sum that has to be paid is known in advance. It is stipulated in the contract. So there is no uncertainty affecting the cost of the claim. When it comes to the date of the payment is clear, is immediately after the death. So there is no ambiguity there. So it's easier to handle technically. But this is only a small part of life insurance, the insurance in case of that. The biggest part is it concerns the retirement issue and the pensions issue. Okay? In this case, life insurers are providing possibilities for people to accumulate money so that they can get a decent life after they retire through a pension which is high enough to cover their current expenses. So you see, in this case, the policies which are sold, even though we still call that insurance policies, life insurance policies, are more like saving instruments, okay? Typically, like banks would sell if you want to save money so that later on you have enough to live decently, okay? And that's the reason why banks are dominant on the life insurance market, okay? So the most important activity of life insurance company has to do with saving and collection of saving, typically as part of pension plans. So you see, in this case, it's totally different. You still have the death element, which is the technically what the insurance, pure insurance dimension. Okay, but about a part of this, or insurance in case of accident or health issues, this is more like traditional insurance. But you know, the dominant activity, most of the funds which are collected are part of kind of saving plans. So it's a totally different, technically totally different story, with totally different type of policies in comparison with which we have seen in non-life. So what are we going to cover? First of all, there is a huge demographic trend, which is an aging trend, so that you have today a pension issue in most countries. And Vietnam is one of these countries. You have a pension issue, and it's important for you to be aware of this. And I start with this, with few demographic consideration and the pension issue, because this is the reason why there are good reasons to believe that there is a huge potential for life insurance in the future in countries like yours, okay? So then what we'll do to look more precisely at what type of life insurance policies, what type of policies exist, okay? How they are built, how they are designed, and how people would look at it to select the best solution. And then I will have a focus more on pension plans, on pension funds, which are different from life insurance companies. Usually they have a much longer maturity, but it's very close to life insurance, and that's why it's good to have a look at pensions with all kinds of tricky aspects. Typically, if you look at how to account for these pension plans. Okay, so indeed, I'm looking at my watch. It is 5 minutes to the end of the course, which means for you 5 minutes to 9, if I'm right. But indeed, you understand that I will not start my presentation now. So, except if there is a question, I will stop here, okay, for today, and say now see you later, because we are not going to meet next week. I think you have another course together with MBA students. So we'll see us 1 week later, you know. So see you later. If I remember well, I think it's 14th of March. Okay, maybe the 13th. I don't remember exactly, but don't worry. It's clearly on my agenda. And have a good weekend. Well, it's a bit of a joke because the weekend is finished for you. The weekend is finished for you. It's not quite finished for me because I still a full afternoon for my Sunday. Okay, have a good dinner at home if it's not too late. Okay, but I know that Vietnamese people can have dinner very late, you know. So I'm pretty sure that you will take a rest maybe a bit, because you deserve that after having listened to me all this morning long for me and afternoon for you. Okay, see you.